Hey, I'm Justin, the home loan guy. I handle regular homes but specialize in non-traditional mortgages for situations where traditional financing might not be the best fit. So most people know about conventional FHA, VA, and USDA loans. And for a lot of people, one of those is absolutely the right idea. But what happens when finances, your investment strategy, or even the property you're buying doesn't fit neatly into traditional guidelines? That doesn't mean you're out of options. So what I want to show you is 5 situations where non-QM mortgage may give you another option. So first, what does non-QM actually mean? Non-QM stands for non-qualified mortgage. A qualified mortgage is a specific category created under federal mortgage regulations. It has certain requirements and consumer protections around how loans can be structured and how the borrower's ability to repay is evaluated. A non-QM mortgage falls outside of that specific qualified mortgage definition. For us, the important part is what that can allow us to do. And depending on the program, we may be able to look at income, assets, rental properties, previous credit events, or certain properties differently than we would with traditional financing. So non-QM does not mean the borrower is not qualified. It means we have another way to look at the situation. And so here's some really good examples, some common examples. Let's say you're self-employed. Your business is doing well and money is constantly coming into your business. But after your business expenses and deductions, your tax returns don't show enough income to qualify for the home you want. So what else can we do? With certain non-QM programs, we may be able to use the deposits from your bank statements to calculate qualifying income instead of relying on your tax returns. And that gives us a completely different way to look at your income of a self-employed borrower. So if you've been told your tax returns just don't show enough income, that may not necessarily be the end of the conversation. Now let's say you're a real estate investor. You already own a few rental properties and you want to buy another one. But all of these mortgages are starting to affect your personal debt to income ratio. What if the property you're buying could help qualify for that mortgage? That's where a DSCR loan comes in. DSCR stands for debt service coverage ratio, but you don't have to remember that. But in simple terms, we're looking at the rent the property is expected to generate, comparing that to the property's housing expense. So instead of the loan being driven primarily by your personal income, we may be able to qualify the investment based more heavily on the property itself. For someone trying to continue building a rental portfolio, that can open up a very different way to finance properties. Here's another situation traditional income calculations may not capture very well. What if you have plenty of money, but you don't show enough regular monthly income to qualify? Maybe you're retired. Maybe a large portion of your wealth is sitting in investments or retirement accounts. Certain programs may allow us to use eligible assets to create qualified monthly income. The lender takes eligible assets, applies their calculation, and determines an amount that can be used as monthly income for the mortgage. So instead of those assets just sitting in the background of the application, they may actually help you qualify. So for someone who has built significant wealth but doesn't receive a traditional paycheck, that can be a really useful option. Now let's change the problem completely. What happens if you had a bankruptcy, foreclosure, short sale, or another major credit event? But you've recovered. Your finances are in a better place. But traditional mortgage guidelines tell you that you still have to wait. Certain non-QM programs may allow financing before that traditional waiting period is over. So instead of the answer automatically being, come back in a few years, we may be able to ask, is there another program available now? For somebody who has already rebuilt financially, that can be a very important difference. And sometimes there's nothing wrong with the borrower at all. Your income works, your credit works, you have the money you need. Then you find the perfect condo you want to buy and discover the condo project doesn't meet traditional mortgage guidelines. Maybe too many of the units are investor owned. Maybe there's an insurance issue. Maybe there's commercial space or another project level issue. So traditional finance may say no because of the condo project, even though you personally qualify. There are non-QM and non-warrantable condo programs that may accept certain projects that traditional financing will not. So a condo that gets a no through traditional financing may still have another financing option. So look at how different these 5 situations are. We used bank statements instead of tax returns. We looked at rental property income. We used assets to create qualifying income. We looked at financing after another major credit issue. And we looked at a property that didn't fit traditional condo guidelines. And that's why I really like non-QM programs. They give me more ways to look at a situation instead of stopping at the first no. And these are only 5 examples. There are plenty other non-QM programs and situations that we haven't even touched on. So my goal here isn't for you to memorize all these programs. It's to get you thinking, if I didn't qualify for traditional financing, is there something else out there? Sometimes the answer may be yes. And this is where my job comes in. I want to understand the whole situation first. What are you trying to accomplish? What does your income look like? What assets do you have? Are you buying a home to live in or an investment property? Is there something unusual about the property? Then we can compare the available options. If traditional mortgage is the best fit, that's great. If it isn't, that's when knowing these other programs can really matter. The goal is finding the loan that makes the most sense for your situation. And so here's my question for you. Have you recently been denied for traditional mortgage? Or maybe you never actually got to the denial. Maybe you talked to somebody and were simply told that your income, your credit history, your investment properties, or the property you want to buy just didn't fit the guidelines. Drop a comment below and tell me generally what happened. You don't need to put private financial information in the comments. Just tell me what the roadblock was. There may be another mortgage option worth exploring. Sometimes the answer is traditional financing. Sometimes it isn't. But before we assume you're out of options, it may be worth taking another look.